Let me tell you about the phone call that changed everything I know about retirement income. It was from my aunt, a woman who had worked her entire life as a teacher, saved diligently, retired with what she thought was a comfortable nest egg. She was 71 years old, and she was terrified. She told me she was running out of money, not because she had been irresponsible, not because she had made wild bets in the stock market, but because the strategy her financial advisor had put her in was slowly bleeding her dry. She owned bonds that paid almost nothing after inflation. She owned dividend stocks that had cut their payments. She was withdrawing from principal every month and watching her account balance shrink. She asked me a simple question that I will never forget, David. How do I get $100,000 a year in income without running out of money before I die? That question forced me to think differently about retirement income. I had spent my career generating returns, beating benchmarks, building wealth, but generating reliable income that lasts a lifetime is a completely different problem. And most of the conventional advice is dangerously wrong. Today, I am going to share the strategy I developed from my aunt and have since refined for anyone over 65 who needs to generate serious retirement income. This is not about getting rich. This is not about beating the market. This is about creating $100,000 per year in income that you can count on, that will last as long as you live, and that will grow to keep pace with inflation. If you are over 65 and you need income, this might be the most important financial information you ever receive, because the decisions you make now will determine whether you spend your retirement in comfort or in constant anxiety about money. Let me start by explaining why the conventional approach to retirement income fails so many people. The traditional advice is to build a portfolio of bonds and dividend stocks, withdraw 4% per year, and hope for the best. This worked reasonably well when bonds yielded 6 or 7% and dividend stocks were plentiful. But the world has changed. For the past 15 years, bond yields were near zero. Retirees who followed the conventional advice earned almost nothing on the safe portion of their portfolio. They were forced to withdraw from principal, slowly depleting their savings. Even now, with rates higher, bond yields barely keep pace with inflation. You are not building wealth, you are running in place. Dividend stocks have become problematic too. Many of the traditional dividend payers have cut or eliminated their payments. The companies that still pay solid dividends are often in declining industries or trading at elevated valuations. Chasing yield in dividend stocks often means taking on more risk than retirees realize. And the 4% rule, which was developed based on historical data, may not work in the current environment. When valuations are high and expected returns are lower, 4% might be too aggressive. Some researchers now suggest 3% or even lower as a sustainable withdrawal rate. If you have $2.5 million saved and you can only safely withdraw 3%, that is $75,000 per year before taxes. That might not be enough for the retirement you envisioned. And if you have less saved, the math gets even worse. This is the retirement income crisis that nobody talks about. Millions of Americans who did everything right, who saved and invested for decades, are discovering that their savings will not generate the income they need. They face a choice between reducing their lifestyle or risking running out of money. I refuse to accept that choice. There is a better way. And I am going to show you exactly how it works. My strategy for generating $100,000 in annual income has 4 components. Each component serves a specific purpose together. They create a system that provides reliable income, protects against inflation, and ensures you never run out of money. The first component is maximizing Social Security. This is the foundation of retirement income, and most people get it completely wrong. Social Security is the only asset you have that is guaranteed to pay you for as long as you live, no matter how long that is. It adjusts for inflation, it cannot be outlived, it is backed by the full faith and credit of the United States government. There is no other asset with these characteristics. Most people claim Social Security too early. They take it at 62 because they want the money now or because they are afraid the program will run out. Both of these reasons are mistakes. When you delay Social Security from 62 to 70, your benefit increases by approximately 76%. That is an 8% increase per year, guaranteed. Where else can you get an 8% guaranteed return? Nowhere. The math overwhelmingly favors delay. Let me give you specific numbers. Say your benefit at 62 would be $18,000 per year. If you delay to 67, your full retirement age, it grows to about $25,000. If you delay to 70, it grows to about $32,000. That is an extra $14,000 per year guaranteed for life, adjusted for inflation. Over a 20-year retirement, that extra $14,000 per year adds up to $280,000. Over a 30-year retirement, it adds up to $420,000. And that does not account for the inflation adjustments, which make the numbers even more favorable. The counterargument is that you might die early and never collect. This is true. But Social Security is insurance, not an investment. You are insuring against the risk of living a very long time and running out of money. That risk is far more devastating than dying early, which you will not be around to regret. For a married couple, the math is even more compelling. When one spouse dies, the surviving spouse keeps the higher of the two benefits. If the higher earner delays to 70, that maximized benefit continues for the surviving spouse for the rest of their life. This is valuable insurance against the financial devastation that often accompanies widowhood. My recommendation is simple. If you can possibly afford to delay Social Security until 70, do it. Use other savings to fund your living expenses during the delay period. The higher guaranteed income will serve you well for the rest of your life. For our $100,000 income target, let us assume your maximized Social Security benefit at 70 is $32,000 per year. That is nearly a third of our goal from a source that is guaranteed for life and inflation, adjusted. The second component is what I call the income floor. This is guaranteed income beyond Social Security that covers your essential fixed expenses. Your essential expenses are the things you must pay regardless of what happens in the markets. Housing, including mortgage or rent, property taxes and insurance utilities, food, healthcare premiums and out-of-pocket costs, transportation, basic insurance. These are non-negotiable expenses that you cannot reduce significantly without major lifestyle changes. I want these essential expenses covered by guaranteed income sources. Income that does not depend on market performance. Income that will keep coming even if stocks crash 50% or bonds lose a quarter of their value. Social Security covers part of this. But for most people, there is a gap between Social Security and essential expenses. Filling this gap with guaranteed income provides tremendous peace of mind and eliminates the risk of being unable to pay your bills in a market downturn. The primary tool for filling this gap is a single premium immediate annuity. I know annuities have a bad reputation. Many annuities are expensive, complicated products that benefit the salesperson more than the buyer. But a single premium immediate annuity is different. It is simple, it is transparent, and it provides something no other investment can provide, guaranteed income for life. Here is how it works. You give an insurance company a lump sum in return. They pay you a fixed amount every month for as long as you live. No matter how long, if you live to 105, they keep paying. The insurance company pools the longevity risk across thousands of people. Some die early and subsidize those who live longer, but everyone gets more income than they could safely generate on their own. Let me give you specific numbers. At current rates, a 65-year old man might receive about 6% of his premium as annual income. So a $500,000 annuity would pay about $30,000 per year. A 65-year old woman would receive slightly less because women live longer on average. That $30,000 per year, combined with the $32,000 from Social Security, gives you $62,000 in guaranteed income. That is 62% of our $100,000 target, from sources that cannot run out and do not depend on market performance. Now, I know some of you are resistant to annuities. You worry about dying early and the insurance company keeping your money. You worry about inflation eroding the fixed payments. You worry about tying up capital that your heirs could inherit. These are legitimate concerns on dying early. You can buy annuities with period-certain guarantees, a 10-year period. Certain means that if you die in year 3, your beneficiaries receive payments for the remaining 7 years. This costs a bit in terms of lower payments, but it provides insurance against early death on inflation. You can buy inflation, adjusted annuities, though they start with lower payments. Or you can address inflation through the other components of this strategy. The guaranteed income floor does not need to keep pace with inflation if you have other assets that provide inflation protection. On leaving money to heirs, I would ask you this: what is more important, leaving money to your children or not running out of money yourself? Your children can take care of themselves. You cannot work another 30 years if you run out of money at 85. The annuity protects you. That should be the priority. The third component is what I call the income bridge. This is a portfolio of investments designed to generate current income while providing some growth and inflation protection. We have $62,000 in guaranteed income from Social Security and the annuity. We need another $38,000 to reach our $100,000 target. This $38,000 will come from a portfolio of income generating investments. The key here is balance. We want income, but we also want growth to keep pace with inflation. We want safety, but we need enough return to sustain withdrawals. We want diversification across different types of income, producing assets. My recommended allocation for the income bridge is as follows: 30% in dividend growth stocks. Not the highest yielding stocks, but companies with a track record of growing their dividends over time. Companies like Johnson & Johnson, Procter & Gamble, PepsiCo. These are businesses that have increased their dividends for 25 years or more. They yield 3 to 4% currently. But the dividends grow 5 to 7% annually. Over time, the yield on your original investment increases substantially. The beauty of dividend growth stocks is that they provide both income and inflation protection. As the dividends grow, your income grows. As the companies become more valuable, your principal grows. You are not just harvesting income, you are owning pieces of businesses that become more valuable over time. 25% in real estate investment trusts or REITs. These are companies that own real estate, including apartment buildings, office buildings, warehouses, data centers, healthcare facilities. They are required to distribute at least 90% of their taxable income as dividends, which typically results in yields of 4 to 6%. REITs provide inflation protection because rents tend to rise with inflation. When the cost of living increases, landlords can charge more. This inflation protection is valuable in a retirement portfolio, where you need your income to maintain purchasing power over decades. I focus on REITs in sectors with strong fundamentals. Data centers benefit from the growth of cloud computing and artificial intelligence. Industrial warehouses benefit from e-commerce. Healthcare facilities benefit from an aging population. Avoid office and retail REITs, which face structural headwinds. 20% in high-quality corporate bonds. Not junk bonds, which carry significant default risk. Investment-grade bonds from companies with strong balance sheets and stable cash flows. The yields are not spectacular, maybe 5 to 6%, but the income is reliable and the principal is relatively safe. I use a bond ladder approach. Buy bonds that mature in 1 year, 2 years, 3 years, 4 years, and 5 years. As each bond matures, reinvest the proceeds in a new 5-year bond. This provides predictable income while managing interest rate risk. If rates rise, you benefit as maturing bonds get reinvested at higher rates. If rates fall, you still have the higher yielding bonds in the ladder. 15% in preferred stocks. These are hybrid securities that combine features of stocks and bonds. They pay fixed dividends, typically 5 to 7%, and have priority over common stock in case of bankruptcy. They are less volatile than common stocks, but offer higher yields than most bonds. Preferred stocks are particularly useful for retirement income because of the high yields and relative stability. The main risk is that the company might suspend the preferred dividend if it gets into financial trouble. To mitigate this risk, focus on preferred stocks from financially strong companies, particularly large banks and utilities that are heavily regulated. 10% in Treasury inflation, protected securities, or TIPS. These are government bonds whose principal adjusts with inflation. If inflation runs at 3%, your principal increases by 3%. The interest payments are based on the adjusted principal, so they increase with inflation too. TIPS are the purest form of inflation protection available. They guarantee that your purchasing power is maintained, regardless of what happens to inflation. The yields are modest, but the inflation protection is valuable insurance. With this allocation, a $1 million income bridge portfolio might generate roughly $50,000 per year in income, between 4 and 5% overall from a diversified mix of income sources. But we only need $38,000 to reach our $100,000 target. That means we can either use a smaller portfolio or withdraw less than the full income generated, allowing the portfolio to grow over time. Let me put specific numbers to this. If you need $38,000 from your income bridge and the portfolio yields 4.5%, you need roughly $850,000 in the income bridge combined with the $500,000 in the annuity. You need total retirement savings of about $1,350,000 to generate $100,000 in annual income. That is a more achievable number than what the 4% rule would suggest. The 4% rule would require $2.5 million to generate $100,000. My approach requires roughly half that because we are using guaranteed income more efficiently and accepting some liquidity in the annuity. The fourth component is the emergency reserve and growth bucket. This is money set aside for unexpected expenses and long-term growth. Even with a well-designed income strategy, life throws curveballs, medical emergencies, home repairs, helping family members in crisis. You need accessible cash for these situations without being forced to sell investments at bad prices or disrupt your income strategy. I recommend keeping at least 1 year of expenses, so $100,000 in our example, in a high-yield savings account or money market fund. This money earns interest, but is completely liquid. You can access it within days if needed. Beyond the emergency reserve, any additional savings should be invested for growth. This is money you do not need for current income, but want to grow for future needs. Potential healthcare costs or legacy to heirs. The growth bucket should be invested primarily in stocks, specifically low-cost index funds that track the broad market, the S&P 500 or a total stock market fund, over long periods. Stocks provide the best returns and the best inflation protection. This growth bucket ensures that your wealth continues to expand even as you are drawing income from other sources. The growth bucket also serves as a long-term backstop for income. If the income bridge underperforms, if dividends get cut, if REIT values decline, you can draw from the growth bucket to supplement income. This flexibility provides an additional layer of security. Now let me put this all together with a complete example. Meet John and Mary, both 65 years old, with $1.8 million in retirement savings. They want $100,000 per year in income, adjusted for inflation. That will last as long as either of them lives. Step 1, maximize Social Security. John's benefit at 70 will be $34,000. Mary's benefit at 70 will be $26,000. Combined $60,000 per year in guaranteed inflation-adjusted income. To bridge the gap until 70, they will draw from savings. Step 2. Build the income floor. They purchase a $500,000 joint life immediate annuity with a 10-year period. Certain, this pays them $30,000 per year for as long as either of them is alive. Combined with Social Security, they will have $90,000 in guaranteed income starting at 70. Step 3. Build the income bridge. They invest $800,000 in the diversified income portfolio I described. At a 4% withdrawal rate, this generates $32,000 per year. But they only need $10,000 to reach their $100,000 target. The extra $22,000 gets reinvested, growing the portfolio over time. Step 4. Establish reserves and growth. The remaining $500,000 goes into an emergency reserve of $100,000 in cash and a growth bucket of $400,000 in stock index funds. The result, at 70, John and Mary have $100,000 in annual income, $60,000 from Social Security guaranteed for life and inflation, adjusted $30,000 from the annuity guaranteed for life, $10,000 from the income bridge, with the rest reinvested. They have $100,000 in liquid emergency reserves. They have a growth bucket that will compound over time, providing inflation protection and a legacy for heirs. They have a diversified income bridge that will grow as dividends increase. If one of them dies, the survivor keeps the higher Social Security benefit, the annuity continues, and the income bridge remains intact. The surviving spouse will still have close to $100,000 in income. If they live to 95, Social Security and the annuity keep paying. The income bridge has likely grown substantially. The growth bucket provides additional resources. They never run out of money. This is the power of a properly designed retirement income strategy. Multiple sources of income, guaranteed income covering essential expenses, diversified investments for growth and flexibility, reserves for emergencies. It all works together to provide security and peace of mind. Let me address some common questions and objections. What if I do not have $1.8 million? The strategy scales down. If you have $1 million, you buy a smaller annuity and have a smaller income bridge. Your total income might be $70,000 instead of $100,000. But the structure remains the same. Maximize Social Security. Build guaranteed income. Diversify your investments. Maintain reserves. What if interest rates change? Higher interest rates are generally good for this strategy. Annuity payouts increase. Bond yields increase. Your income bridge generates more income. Lower interest rates hurt, but you are protected by the guaranteed income floor. The diversification across income sources provides resilience. What about inflation? Social Security adjusts for inflation. The dividend growth stocks increase their dividends over time. REITs raise rents with inflation. TIPS provide explicit inflation protection. The growth bucket compounds and provides a hedge against rising prices. Inflation is addressed throughout the strategy. What if the stock market crashes? Your guaranteed income from Social Security and the annuity is unaffected. Your income bridge might decline in value, but the dividends and interest payments typically continue. You can draw from your emergency reserve while waiting for the market to recover. The growth bucket provides long-term recovery potential. You never have to sell stocks at depressed prices to fund living expenses. Should I work with a financial advisor? Implementing this strategy correctly requires some expertise. Selecting the right annuity, building a diversified income bridge, and managing the overall plan is complex. A fee-only fiduciary advisor can help. Avoid advisors who earn commissions on product sales. They have incentives to recommend products that benefit them rather than you. Let me share some additional insights that will help you implement this strategy effectively. On timing annuity purchases. You do not have to buy the annuity all at once. You can ladder your annuity purchases, buying a portion at 65, another portion at 68, and another at 71. This reduces timing risk and allows you to benefit if interest rates rise. An annuity selection. Not all annuities are created equal. Compare quotes from multiple insurance companies. Focus on the financial strength of the insurer, as they will be paying you for decades. Avoid annuities with complex features like variable rates or equity participation. Simple is better. On managing the income bridge, reinvest dividends and interest during years when you do not need the income. This allows your portfolio to compound. In years when you need more income, you can take the distributions. This flexibility is valuable. On tax efficiency, different income sources have different tax treatments. Social Security may be partially taxable. Annuity income is partly return of principal and partly taxable. Dividends may qualify for lower tax rates. Bond interest is taxed as ordinary income. Work with a tax professional to optimize the order of withdrawals and minimize your tax burden. On reviewing and adjusting, this is not a set it and forget. It's strategy. Review your plan annually. Rebalance the income bridge if allocations drift. Adjust withdrawals based on portfolio performance. Update your plan if circumstances change. Active management, even if minimal, improves outcomes. Let me close with the most important point of all. The goal of retirement income planning is not to maximize returns. It is not to beat the market. It is not to die with the largest possible estate. The goal is to fund a comfortable retirement without running out of money. To live with security rather than anxiety, to enjoy your final decades rather than worry about finances. The strategy I have outlined achieves this goal. It provides guaranteed income that covers essential expenses. It provides diversified investments that generate additional income and growth. It provides reserves for emergencies and flexibility. It provides a framework that works across different market environments and different lifespans. This is what I built for my aunt. She no longer calls me in tears, worried about running out of money. She has $100,000 per year in income, more than she ever thought possible. She travels, she spoils her grandchildren, she enjoys her retirement, and she sleeps well at night knowing that the money will last. That is what I want for you. Not wealth for its own sake, not beating some benchmark. Peace of mind, security, the freedom to enjoy the retirement you have earned. You have worked your entire life, you have saved and sacrificed. You deserve a retirement that is comfortable and secure. This strategy can provide that. Follow the 4 components. Maximize Social Security, build the income floor, diversify the income bridge, maintain reserves and growth. Own $100,000 per year in retirement income. It is achievable, it is sustainable, and it can be yours.